We're about to witness $4.7 trillion flowing into the US economy over the next 9 months. That's not hyperbolic, that's not sensationalism, that's the actual number when you add up the tax refunds, the corporate repatriation, and the capital expenditure. So you might be thinking, what does this have to do with some semiconductor company? And you've never heard of this semiconductor name, possibly. It's a fair question, but here's the connection. When that much capital enters the system, it doesn't just sit there, it flows, and it tends to flow towards infrastructure, particularly the kind of infrastructure that powers what everyone's calling the AI revolution. Revolution might be too dramatic a term. Let's just call it a significant reallocation of capital towards computational capacity. That sounds more measured, more appropriate, and investable. And here's where our mystery company comes in. But first, let me give you some context because this really matters. The company is Astera Labs, ticker symbol ALAB. And before you close this video thinking, great, another AI chip company, let me stop because that's not quite what they're all about. The difference here is actually important. Astera Labs doesn't make the chips. I gave you the ticker, but they make the connectivity, the plumbing, if you will, the infrastructure. It allows all these expensive NVIDIA GPUs to actually talk to each other and talk to the memory. And you saw the run that memory just made. So I know that doesn't sound particularly exciting. Plumbing, never does. But here's the thing about this type of plumbing. It's essential. And when you're the best at it, you become indispensable, which brings me to A-Lab's recent earnings. Q4 2025 earnings. These numbers are, important. $220 million when it's up 150% year over year gets interesting. 150%. That's big. $690 million in revenue, up 78% from the previous year. And you might say, sure, that's small companies can grow fast. Fair point. But as we look towards all these earnings coming out in January, a gross margin of 70%, 77% for A-Lab on hardware is crazy. So it's incredibly rare. NVIDIA's gross margin is around 74%. They're the undisputed king of AI chips. So Astera Labs is doing better than that slightly on connectivity solutions. So that's not just good, that's almost absurd. And their operating margin of 21% it's already making them profitable at this scale, at this growth rate. So that combination almost never happens. And, operating margin, it could become unprofitable at some point, but the timing is ripe to buy this company, I believe. Companies are repatriating over $1 trillion. And where's that going to go? Well, 40% is going to go to buybacks, 30% to dividends. At 10%, though, $200 billion goes to actual investment. And what are the big tech companies investing in right now? Data centers. AI infrastructure, the kind of infrastructure that requires massive amounts of connectivity, the kind of connectivity that Astera Labs specializes in. Goldman projects hyperscaler capex at $600 billion in 2026, $1.15 trillion from 2025 to 2027, and every single dollar of that requires connectivity. And Astera is the leader in the specific kind of connectivity that these data centers need. They make PCIe retimers, they make CXL controllers, they make the things that are hard to pronounce and make AI actually work at scale. So these terms sound technical, they are technical, but here's what you need to understand as an investor. Without Astera's products, those NVIDIA GPUs that everyone's so excited about, they can't work together efficiently. They can't access memory at the speeds that they need. The entire system bottlenecks. So when hyperscalers are spending $600 billion on AI infrastructure, they need Astera's solution, not want, need. And there's a difference. So let me tell you who Astera's customers are, because this matters. Microsoft, Amazon, Google, Meta, Oracle, basically every hyperscaler that's building AI infrastructure. And here's the beautiful part. These customers aren't buying from Astera because they like them. They're buying because they have to, because the alternatives either don't exist or don't perform as well. Astera has design projects with all the major cloud providers. And once you're literally into the data center architecture, you're very sticky because changing out your connectivity infrastructure is expensive and risky, and nobody wants to do it. unless they absolutely have to, which means Astera's revenue isn't just growing, it's recurring, it's predictable. It's the kind of revenue that Wall Street loves. Now, here's where I get a bit uncertain, and I think uncertainty is appropriate here. Astera Labs currently trades at about 30 times forward revenue, so that's expensive. There's no way around that. It's a high valuation, but here's the context. They're growing at over 150%. They're already profitable. They have 77% gross margins, and they're essential infrastructure for the biggest capital expenditure cycle in tech history. So the question isn't whether 30 times revenue is expensive in absolute terms. The question is whether it's expensive relative to what they're going to be earning in 2 years. And that's where the math kind of works out, right? If they maintain even half their current growth rate, say 75%, they'll do 1.2 billion in revenue in 2026 at their current margins. That's about 250 million in operating income. If they do 2 billion in 2027, which seems plausible given the capex numbers for hyperscalers, that's over 400 million in operating income. And suddenly you're not paying 30 times revenue, you're paying maybe 15 times forward earnings for a company growing at triple digits. So with 77% gross margins, serving customers who literally cannot build AI infrastructure without their products, that doesn't sound expensive. So it sounds, and there's risks, but the technical setup seems great right now. It has higher lows since November, but they do have risks such as competition from Broadcom or Marvel. They could develop better connectivity solutions than Astera. It's possible, though Astera has a major technical lead right now. There's also the risk of customer concentration. If you're getting most of your revenue from 5 customers, that's risky. If one of them decides to bring connectivity in-house, that's a problem. Though the economics of doing that don't really make sense for the hyperscalers, Meta, Google, etc. So the third risk, the valuation, right? If growth slows at all, this stock could get cut in half, maybe worse. High growth, high valuation stocks are fragile. And when the story changes, they don't decline, they really collapse. So the fourth risk is the market timing. We could hit a broader market correction. It's possible, right? The market pulled back a little last week. And when that happens, the high multiple names get hit. Astera isn't immune from that. So those are the major concerns. I'm not dismissing them, but I think the opportunity right now might outweigh the risk, particularly for people who use stop losses. So let me walk through how I think this plays out. $4.7 trillion. That wave isn't going to hit all at once. It comes in 5 distinct waves, and each wave benefits Astera slightly differently. So wave number 1 right now through March, this is the front-running season. Institutional investors positioning before the tax refund flood. Growth stocks outperform, high multiple tech outperforms. Astera benefits as capital flows into AI infrastructure. The second wave is April through June, the tax refund wave. 1.2 trillion hits consumer bank accounts. 20% of that, 240 billion flows into investment accounts. Retail investors buy what they know. They buy the AI names. They buy NVIDIA. Yeah, but they also buy companies NVIDIA needs, and I think they're going to learn about Astera as we get towards that. Another factor is the corporate repatriation. So 2 trillion comes back home, 40% to buybacks, 10%, 210 billion to investment. And what are the tech companies investing in? AI infrastructure, data centers, connectivity. And Astera's products, they're going to be at the center of that. The last quarter of 2026, there's going to be a boom, 1.4 trillion accelerated depreciation. Companies can write off investments immediately. So that's a big incentive to spend now. Who's going to benefit? Infrastructure providers, connectivity companies, Astera Labs. The fifth wave is ongoing. It's the structural demand from AI infrastructure. So 600 billion in hyperscaler capex in 2026, 1.15 trillion through 2027. You've heard that number. This isn't a one-year phenomenon. This is a multi-year cycle. And Astera is positioned at the center of it. So I don't know if Astera Labs is going to be the best performing stock in 2026. I don't know if it's going to break out this week. I don't know if it's going to double. I don't know if it's going to triple. I don't know for sure it's even going to go up, but I do know that this is an excellent opportunity. The numbers are exceptional. It's right at a breakout point. They're in the right place at the right time coming into Monday when people are excited to buy. And the timing aligns with the largest capital wave in decades. So I don't think the markets fully appreciate what this company is yet. They still think of it as some connectivity company, but it's not just connectivity. It's essential infrastructure. It's the plumbing. that makes AI work. And when you're the best AI plumber, the biggest construction boom in history, it's worth paying attention to this company. So here's what I'm doing. I'm watching it closely. I'm not going all in, of course. I'm not betting the farm. But I'm positioning. I did take an attempt on Friday. I got stopped out. But with the margins, the customer list, the capital wave, the timing, it all points to something worth considering going into Monday and early this week. I might be wrong. I might be seeing connections that aren't there. But even if you win 30% of the time, you still do really well in this game. So valuation might be too high. It's possible. It's what makes this interesting. So if you're considering Astera, this is how I'd think about it. This is just my plan. Basically, do what makes sense for you, but the conservative approach is a small position, dollar costing average over 3 months. You can take that starter position now, add on any meaningful dips, build slowly as the thesis proves out. That's one way. A moderate approach is a meaningful position now before the second wave hits. The tax refund wave starts in April. If you wait until then, you probably miss some upside. The aggressive approach, of course, is a larger position now, possibly with calls for Q3 or Q4 to use that corporate repatriation wave and CapEx hit in the second half of 2026. If that plays out, that's when you'll see the maximum impact. But understand the risk. Options can go to zero, right? Large positions can hurt badly if you're wrong. I told you I got stopped out, and I'm probably somewhere between conservative and moderate, sometimes very conservative. But I think the thesis is strong, and I can't think of a better stock right now. I could be completely wrong, but I'd rather, give it a shot, maybe miss some upside rather than blow an account. So the fourth point to mention is important. $7 trillion flooding the economy will cause inflation, and that's just how it works. That's math. The Fed will eventually respond, probably not in 2026, but likely in 2027. And when inflation comes back and rates start rising again, high multiple growth stocks get hit hard. So this trade has a shelf life. You can't just buy and forget. You need an exit strategy. And for me, that probably would mean a good time to take profits would be a big run into Q3 or Q4. Just be very aware of inflation data. If CPI starts creeping back up towards 3%, that's your signal. That's when you start rotating from growth to value, from tech to energy, from Astera to inflation hedges. But that's a 2027 problem. So for 2026, the setup's bullish. And that's the situation. Exceptional growth, absurd margins. They're in the right spot. We'll talk about exact entries in the Discord, but this is the best capital wave opportunity in decades, possibly. So I don't think it's unreasonable to talk about a stock that is so beaten down right now. It's worth understanding. It's worth watching it, worth considering it. Because when I look at everything that's about to happen in 2026, the tax refunds, the repatriations, the CapEx boom, the AI infrastructure spending, and I think about where the stock is positioned on the chart, which companies are positioned to capture that wave and look good technically, Astera Labs just doesn't stop. It keeps coming up. It's not the most obvious, but it's very essential, and sometimes being essential is actually better than being super exciting. That's a stock I've been thinking about for the last few days. Make of it what you will. If you want more analysis like this, try our community for $25 for 7 days at stockscommunity.com. And if you want the transcript of these videos, get the free newsletter at free.stockscommunity.com. It's down below. Hit that like button if this was helpful. Subscribe if you want more. And let me know in the comments what you think. Am I right about this? Am I missing something? Something obvious? Either way, I want to hear it. All right, that's all I have for today. Good luck out there. And remember, do your own research, make your own decisions. I'm just sharing what I'm seeing. You decide what to do with it.
Sam Putnam.
This is Sam Putnam. This is Sam Putnam.